beauty AI company Oddity made its public debut, and as predicted on our show last week, the shares got a pop. The stock rose more than 35%. That's on top of the fact that they were repriced higher before the IPO. Scott, reactions?
In terms of AI company Oddity, we made this prediction, and it was an easy prediction. There's just very few good companies in the chute here. And Oddity is kind of this rare company, and I want to be clear, I bought stock in the IPO yesterday. There's very few companies in the chute who are growing 30, 40, 60% a year and also profitable. And they're leveraging technology and AI to match the perfect skin tone using something called spectral photography and AI. Okay. And I think that creates a feeling of security and barriers of exit around going to another foundation. They launched this other brand called Spoiled Child, and they're very good at moving people down the funnel of being just a browser on their website to doing a ton of A/B testing, using machine learning to get them to convert at higher rates. Really strong margins, but there just aren't that many companies we've seen go public that have managed to thread the needle of growth and profitability at the same time. And the stock was up, I believe it was up 40% on its IPO on its first trade. And I think today, the day after, I thought it would check back a little bit. It's not. It's up another 8%. So you're going to see, it feels like it's a great company, and there aren't that many lined up. And because there's a lag between when you decide to go public and getting public, a lot of this is not their fault in the sense that there's just so much appetite and money on the sidelines ready for a good company, and there just aren't that many queued up on stage, if you will. So anyways, it was an easy prediction, but we got that prediction right.
Are you viewing that as sort of a momentum trade or a long-term investment? Because a lot of what you said around the combination of beauty and technology, and they're leveraging AI, and it's one of the first big consumer IPOs, that sounds sort of momentum based. Are you going to hold for a while?
Well, is it a trade or is it a hold, right? So it's not what I call fully valued right now, but whenever you buy a stock and you could recognize a 45% gain in 24 hours, there's a reasonable temptation to sell and just take the gain, or at least maybe take some off the table. I think I'm a holder here because I think I'm super excited. They're about to launch, or going to launch in 2025, an acne brand. And I think if you look at the ability to absorb with machine learning several million photographs and figure out the right treatment, to me, that sounds really powerful. And when I look at the beauty industry, there really aren't what I'd call a lot of hot growth brands right now. Il Makiage is a really strong brand. It's a strong company. They just got raised a shit ton of capital. They could probably go buy some small beauty-related tech startups. And I think the momentum here is going to take the stock higher. I think this is a company that could be a $10 billion market cap beauty brand and be a reasonable, not a competitor, but a threat to L'Oreal and Estee Lauder, who trade at much larger market caps. So I'm probably a holder here. If it were to double in the next 30 days, I might think about taking my initial investment off the table and playing with the house's money. Yep. One mistake I make, but I continue to make it, is I almost always hold a stock for longer than a year because it just pains me to pay short-term capital gains on a trade. Yep. And quite frankly, sometimes that doesn't work out. Letting the tax tail wag the dog is not a good idea, but I can't help it because if I'm in something 6 or 7 months, I just can't help but think, well, if I just hold on another 5, I get a 10% pop in the stock price because I'm going to pay 22.8 as opposed to 37. And then there are ways to kind of, I don't want to say short it, but limit your upside, but reduce the downside by writing calls and other things you can do. But I very rarely own a stock for less than a year. And if you talk to great investors, usually where they've had really big wins is, I bought $400,000 worth of Apple stock in 2010, and I think it's worth $8 or $10 million now. And any one year it did okay, and some years it was down. But holding a stock, there's nothing that creates wealth, like one, inheriting it, but two, if you're not smart enough to inherit money, two, real estate. The majority of I think if you look at the Forbes 400, a disproportionate amount of them are in real estate, but also buying a good company and holding on to it for a decade. If it can compound at 10, 12, or a company like Apple at 18%, 10 years goes by really fast and you wake up. The way you get wealthy is patience and letting time take over. And if you let time take over and you diversify, you're going to find one of your companies goes up 5, 10, 20x. So I have a bias towards just holding on. And to be clear, it's hurt me a couple times. I invested in the IPO of Lemonade. It went to 200. Now I think it's at 20 or 23. When it was at 200, I probably should have said, okay, as great a company as it is, this makes no sense. And I did sell down, but I didn't sell, I didn't sell all of it. I still own a bunch of it because I like the management team and I like the company. But I'm generally speaking, long-winded way of saying I'm generally speaking a long-term holder. Netflix, other than TikTok, is the biggest beneficiary of the writer strike. Try and find someone who says the following: I canceled my Netflix subscription because there's less content because of the writer strike. The content pool at Netflix right now is the depth of the Mariana Trench. Does anybody know there's a strike on who's watching Netflix? They get my understanding is somewhere between 2/3 and 80% of their content production marches on. I think they have 10,000 people in Madrid making content. So thank you, writers. Thank you, Writers Union. Who is it? The
WGA.
I forget. WGA said the Economic Bureau of Spain. Thank you, says TikTok. And Netflix, just by tightening up password sharing, added 6 million subscribers. They're adding people. They're adding 6 million subscribers. Yeah. And this all goes back to the notion that I think Netflix is the big winner coming out of the strike. I think it's a dream for them. It's a gift to them. And the writers, in my opinion, in the union, and I've been saying this a lot, should absolutely partner with the studios and Netflix and go really hard at the biggest pile of money and basically say, look, we are really going to seriously get in the way of your ability to charge a subscription fee because you are crawling our content everywhere, and we represent almost every content creator in the world. Yeah. And this is the moment. And I was at this moment in 2008 with the New York Times when we were so fascinated with Google that we let them crawl our data and debase our amazing content for pennies on the dollar. We should have all gotten together, the Newhouses, the Murdochs, the Sulzbergers, the people who own the FT, and said, we're going to present one unified front to Google and to Microsoft and the other search guys, and we're going to extract fair value for the fact that we are painting their house every millisecond. And that is what's happening the same moment here. The biggest pile of money is tech as it relates to AI, and that's who the WGA and SAG and AFTRA and the studios should be partnering with to go after.
Yeah.